next hour is on international tax. And what I'd like to talk to you about is more of a survey, kind of a high-level description of some of the issues that you're going to run into in this valley, both on the inbound and outbound side. And and I'll start by telling you that our practice, the Royse Law Firm, I don't know if you know this, we're 25 lawyers now. We do mostly startups, mostly technology, almost all technology, and a wide range of legal services. But I'd say more than half our clients now are foreign companies coming into the United States. And the other half have offshore operations. Just everybody here in this valley is international, and you don't do much around here for very long before you run into international issues. So international tax looms large. We've only got an hour. I'm not going to be able to cover anything in very much depth, but what I'd like to do is kind of do a little bit of a survey of what the rules are. It's kind of the top line rules, and then walk through a couple of common scenarios that we see fairly regularly here, so you can kind of see what to expect and what might happen. So let's kind of start with some basic rules. And by the way, you have on your table not only the slides as a handout, but I've gotten several outlines that I've passed around that go into more detail on all of these issues. And you'll see in the slide, tax issues affecting foreigners doing business in the U.S. I have a pretty good definition of these very important terms, U.S. citizens, U.S. residents. Because as you know, U.S. citizens and residents are taxable on their worldwide income. It's probably one of the problems. Whereas non-resident aliens, rather, are taxable only on their foreign source income, their U.S. source income, and their U.S. effectively connected income. So one of the first questions that we have, one of the threshold questions is, well, what is a U.S. resident? And you'll run into this almost immediately, that people tend to confuse the immigration definition with the tax definition. And they're not the same at all. They are in one sense, that's if somebody has a green card. Because if you have a green card, you're a resident for immigration purposes, you're also a resident for tax purposes, taxable on worldwide income. But beyond that, they differ a lot. And we just have to look at typically the substantial presence test, which I'm sure you're familiar with if you've done any work in this at all. I've got it described on page 2 of the outline. But it's basically if a person is present in the U.S. for 183 days or more during the current year and the preceding 2 years, under a formula that I won't bore you with now, then you pass this test. So we have to go through this numerical analysis with individuals, quite frequently. We can't just rely on the immigration status. And then that's not the end of the inquiry. Then we got to go look at a relevant treaty, because they might be able to get out of U.S. resident status under the tiebreaker rule of a treaty if they happen to be a resident of one of our, 165, 170 treaty countries now. I'm going to leave Dave and Mike to talk about estate and gift tax domicile. Suffice it to say that that's a completely different test than residence as to whether somebody's subject to estate and gift taxes here. So in the business world, where I spend most of my time, we're very concerned with this concept of effectively connected income. And so the idea is that a foreign corporation, remember what I said, they're only taxable in the U.S. on their U.S. source income if it's a certain type of income, and they're effectively connected income. So that's income that's effectively connected with the U.S. trade or business. And we have fairly extensive regulations on this. They're described in the outline. But generally, the determination has to be whether the asset that gave rise, whether there's an asset test of the asset that gave rise to the income, is that used in a trade or business, and some other more purpose-based tests. But number one, is this business income? If it's U.S. business income, then it's taxable here. If it's not, then we go and look at a different test. If it's foreign source income, it's usually pretty hard to tax it here because it's really difficult to have effectively connected foreign source income, in the U.S. So so U.S. source is how we commonly say it, but what we really mean is income that's effectively connected to trade or business. Where we get into trouble, though, is with agents, because that's usually not that tough. It's usually pretty easy to see. If you have a business in the U.S. and that business is making money, you can see that that's U.S. and it's going to be taxed here. Where we run into trouble is when foreign corporations hire agents here in the U.S. to conduct business for them. And typically, a dependent agent, think of an employee, is going to create an office here in the U.S., and the income attributable to that office is going to be taxable here, whereas an independent agent might. All right? And they will, if that independent agent, think of an independent contractor, has the authority to negotiate and conclude contracts and regularly exercises that authority. So that's usually where we have to draw some lines. And there are several cases that dive very deep into the difference between those types of agents and whether they have that authority. But that's one area, it's sort of a gotcha here. The treaties change this rule a little bit by adding the concept of a permanent establishment. So a foreign corporation, even if they've got some business activities in the U.S., are not taxable on their U.S. income unless they have a permanent establishment. And they define that as a permanent place of business. Although be careful about that, because permanence isn't what you might think. I mean, a hotel room can be permanent, you know, if you're there long enough. 2 horse races can be permanent, you know, under some old rulings. But nevertheless, we do have a standard, and it is generally viewed as a higher standard than this effectively connected income standard. That's permanent establishment. I will tell you as a practical matter, even though I've always said I don't think it's that big a difference. In reality, a company, if they're effectively connected, they probably, they're going to have a business here. But as a practical matter, it makes all the difference in the world to an auditor because agents will back off this issue a lot more quickly if there's a treaty country involved because of this permanent establishment requirement than they will if there's no treaty country. So my Taiwan-based corporations, they do business in the United States at their peril. As far as I'm concerned, they're always setting themselves up for an audit because we don't have an income tax treaty with Taiwan. Whereas if you're from China, you probably have less audit risk. So that's business income, right? Business income is taxable here if it's effectively connected. Then there's non-business income. And this is FDAP income, fixed determinable annual periodical income. That's taxable if it's U.S. source, and it's taxable on a withholding tax basis. So dividends, interest, royalties, 30% withholding tax, which is almost always reduced by treaty, but that's where we start. In addition, it's important to note with respect to interest that we have the portfolio interest exception. So almost never is interest taxable. It is if it's paid to a related party, or if it's contingent interest, like equity kickers and real estate mortgages, but typically we get out under the portfolio interest exception. And it makes sense. I mean, who would invest in U.S. obligations if they had to pay 30% withholding tax? Royalties, that's going to be based on where the intangible is actually used. So patent license royalties are going to be subject to tax. This one's a little tricky because not every country applies that rule. So you could end up paying tax, Japan comes to mind, you could end up paying withholding tax on royalties in 2 different countries because they have different source rules. But typically royalties are sourced in the U.S. based on where the intangible is used. Service income, where the services are performed. I don't think I've seen, well, with independent contractors you could have withholding on services, but I think more often what will happen is it'll either be subject to just compensation withholding or it'll be effectively connected because the contractor is doing business here, but theoretically there could be a 30% tax on service income. And I mentioned the treaties and how we always have to, after we consider the general rules under U.S. law, we then have to go to the treaty to determine whether there's a higher standard that actually gets us out of this. And then the last thing I want to mention before we start getting into some examples, branch profits tax. And the idea behind the branch profits tax, and by branch all I mean is just a U.S. trader business. So foreign corporation, remember what I said about dividends. The foreign corporation organizes a U.S. corporation to conduct business here, and there's lots of good reasons they would do that, right? They want to limit their liability. The foreign corporation doesn't want to be subject to tax here directly in the U.S. because they don't want the IRS, especially the state of California, knowing too much about them. So they form a U.S. corporation. The U.S. corporation pays dividends back to the foreign parent, and there's 30% tax withholding. Whereas if they had set up just a U.S. trader business, there wouldn't be other than for this branch profits tax rule. And what the branch profits tax rule does, it basically imposes a 30% withholding tax on repatriation of U.S. earnings from a U.S. branch, that's just a U.S. business, back to the foreign corporation owner. So it's one to watch out for. Generally, you can say that if that it's really a parity whether the foreign entity does business through a corporation or through a branch here. Another reason why I never see a branch. I never see foreign corporations establish U.S. branches, with one exception that I'll get to in a little bit. But that's usually the first question we have when companies come to me from foreign countries. They say, how do I do business in the U.S.? Now, as you know, when companies come here, if all they're worried about is limiting liability as a legal matter, so they can form a corporation or they can form an LLC. And if they form a single member LLC, disregarded entity, right? So now we're in this branch profits tax rule again. It just puts us right back into that scenario. So I don't know what your experience is, but almost never will I use an LLC for a foreign corporation. There's no tax advantage to it, and there's a disadvantage because now the foreign entity has to file a U.S. tax return, right? They got to do the 1120F. Okay, I want to talk a little bit about real estate before we go back. I do have a handout, my FDAP handout, right? So real estate's different. And everything I just said about, investing in U.S. stock doesn't apply when you're investing in U.S. real estate, including corporations that own more than 50% of their assets consist of U.S. real estate. So basically, under FDAP, what FDAP does, the Foreign Investment in Real Property Act, is that it characterizes any gains from the sale, and losses for that matter, any gains or losses from the disposition of U.S. real estate as effectively connected income. It's business income. It's U.S. business income that gets taxed at graduated rates, just like any other business income. So think of the difference. Your foreign person can buy stock in a U.S. company. They can sell the stock, even though it's a U.S. company, and that's foreign source gain because we source sales gain at the residence of the seller, and we escape U.S. tax on that gain altogether. Foreigners, they always seem surprised when I tell them this. It's just hard to believe. They buy real estate, they take the same money and put it in real estate instead. They sell the real estate, they get taxed on it because of FDAP. Much different rule. That's just too much, that's just too U.S., I guess, for us to source in some other jurisdiction. It's what you might expect if somebody's buying real estate directly. Nobody should ever be surprised about that. Where the real planning opportunities are, I guess, is in the corporations that we form to actually buy the real estate. Because remember what I said, foreigners, they don't really want to own anything directly here. They don't want to file U.S. tax returns. So we'll form a U.S. corporation to actually buy the real estate. So that's a U.S. real property holding company. So unlike any other corporation that they could sell a stock of, recognize gain, not pay tax, if they dispose of the stock of the U.S. corporation, the U.S. real property holding corporation, they will have to pay tax on the sales gain from the sale of that stock, and it's enforced through withholding. Okay, that's the 10% withholding. That's all in the outlines. A couple other things I point out is the types of interests that qualify as U.S. real property. Determination dates, by the way, if a company is a real property holding corporation anytime within 5 years, it's going to be treated as a U.S. real property holding company. And as I said, it's a 10% withholding. And oftentimes, and in fact, will the buyer of a corporation would be well advised and almost always gets a representation or a certificate, in fact, a withholding certificate from the seller that they're not a U.S. real property holding. So that's FERPA. That's one exception to keep in mind. I'll talk a little bit about transfer pricing. So we've talked about the withholding, the rules on foreign corporations doing business here. We talked about business income, talked about non-business income, how that gets taxed through withholding tax on the U.S. source income that gets paid out. So, and we talked about branch profits tax. So now if you're a foreign corporation coming into the US, you've probably figured out that you're going to have a foreign corporation, you're going to form a US subsidiary. That subsidiary is going to conduct your business in the US, but the business it's conducting is going to be the business of the foreign parent, right? So it's either going to be buying product and reselling it from its foreign parent, or it's going to be providing services on behalf of its foreign parent, or it's going to be doing marketing, or it's going to be doing research and development. Whatever it is, it's going to be contracting with the foreign parent, right? Or some other foreign affiliate. And that's the transfer pricing rules. And for those of you that are new to this, it's Code Section 482. It looks for controlled entities. It's entities under common control, and it requires all transactions among those entities to be at arm's length prices. The penalties are enormous for transfer pricing mistakes. That's why we're always in audit on these things. It could be 20% or 40% of the underpayment in tax, depending on how big the underpayment is. The way you get out of those penalties is by having adequate documentation, a transfer price study. Now, this is significant because this is one of those areas where it's very clear that you can get out of penalties, even if you're wrong on the tax, just by having that piece of paper, right? That documentation study, that transfer price study. So we call that a penalty study, where the taxpayer kind of sets their prices, it's cost plus 5 or whatever. They're not really trying to play any games, and they get a study, and all the study says is that, yes, you're right, you're within that range. And we could spend a lot of time talking about how to do a transfer price study. It's something that we actually do. But that's just a penalty study, and they get it only to avoid penalties, nothing else. As a practical matter, the service, they come and audit, they give you their IDRs, they ask for the study, you give them your documentation, and they don't ever mention the issue again, because they're not going to get penalties, even if they win. So it's really good insurance. The other type of study is a real pricing study, where somebody is trying to squeeze the last nickel of tax they can out of the system and have the most aggressive transfer price that they can. And they'll do documentation and a transfer price study to set the price. Different kind of study, but the paper serves the same purpose. Gets them out of the penalties if they get caught on it, if they get challenged on this, and if there's any changes. So keep that in mind. That's transfer pricing, just the pricing between the companies. As lawyers, of course, we have to document that. And I want to pause on this because I see a lot of companies make this mistake. They'll even go to the trouble of getting a transfer price study, hire an economist to put together extensive documentation on how to price their intercompany transactions, how to price that sale of property or that service, but then they won't have agreements in place that reflect it. Or worse, the agreements they do have don't really say what their transfer price study says, which might not say what they actually do in process. Maybe they don't pay, within 90, and maybe they do charge interest, and maybe they charge the shipping cost back to the seller, or whatever it is. That's kind of a disaster, because if your agreement is not consistent with your study or with your practice, the IRS will disregard it. They'll just disregard it. They'll say, this is garbage. You guys aren't even following this agreement, so we're not going to. So it's important to follow the agreement. And the agreement's also important because when we price these transactions, we're looking at two things, function and risk. And where do you find that? You find that in the agreement. For example, shipping terms is a good one. You can shift a lot of the risk to some foreign party and therefore shift a lot of the profit to that foreign party through a shipping term, because that's where a lot of the risk is. Title passage is a good one. And all the rest of these, indemnity, price protection is a big point. All of this stuff should be thought about, should go into the agreements, and should be consistent with what the parties do. By the way, before we leave transfer pricing, I want to talk a little bit more about the study, because this is another thing that it's a little counterintuitive. When I say arm's length standard, what we mean is that the pricing that the company has with the affiliate is at the same prices as what they would have with an unrelated party. So how would you think you'd find out, what would your study show? What would your study do to show you that you have third-party pricing? Well, you'd go look at third-party transactions. That's what you'd think, right? That's usually not what we do. That's not what our studies do. And the reason why is because while in theory, yeah, let's go find some third-party transactions, some other products that are exactly like ours, you know, that somebody else sold to a third party, or our products that we sold to a third party. But it almost never do you find those third-party transactions. They're just too different. Instead, what you find is something that's kind of like ours, but then we have to make a bunch of adjustments to adjust for, you know, for payment terms, or for geography is a big one, or for volume, or because that company is way bigger than ours. And by the time you get through all of these adjustments, you don't feel very good about your pricing. So I almost never see that method used. Instead, what we'll see is what we call the comparable profits method, where we'll say, look, instead of finding another company that sells products that are just like ours, we're going to find another company that does business just like we do. Because I can't find very many companies that sell an intangible, or, you know, like I have. But there's a million of them that just do marketing and sales in the U.S., right? There are, all of them that I form, for example. So we can take a look at those companies, and we can see just how profitable they are. And we can back into our pricing by starting with a level of profitability and adjusting the pricing to hit that level of profitability. And that's just one metric, that's one measure. You know, there's others, there are other ratios that we would look at. But we take, in fact, you know, maybe a good transfer price study will have 3 or 4 of them converge. But we'll look at gross profit margin, net income margin, what they call the Berry ratio, stuff like that, assets, income to assets ratio, things like that. And we'll just we'll back into the pricing based on these profitability ratios. That's how these studies are typically constructed. That surprises people a lot of times. Earnings stripping, just briefly, because after we formed the company, now you're thinking, well, how do we capitalize it? Because we're going to have to fund this company. Should it go in as capital? Should it go in as debt? There's probably a desire to put a lot of money in as debt so we get deductible interest, even though there's a withholding tax, unless we have a treaty, right? So we might be able to get non-deductible interest, or we might be able to get deductible interest coming out of the company that's not taxed by the U.S. on the way out. But the earnings stripping rules will deny deductions to companies that are overly leveraged, that are heavily leveraged. So we always have to consult these rules, 163J, when we're capitalizing a company. Let's come back to that. So I just want to mention a couple things about the anti-deferral regime. So everything I talked about now has been companies coming into the U.S. primarily. All right? They're worried about effectively connected income, and are worried about being taxed on their passive U.S. source income. Now let's suppose that you've got a company, like you have an entrepreneur like I'm seeing more and more, walks into your office and they read an article where John McCain was complaining about Apple, you know, not paying any tax, and Google having stateless income, and they heard something about a double Irish, you know, Dutch sandwich, and they want to be just like Google. They don't want to pay tax and their income either. And there was a time, I mean, 20 years ago, you just said, well, that's fine, I can do that for you. Just write me a check for $200,000 and we'll put that in place. Well, it's a lot easier these days because income is so mobile, you know, and companies can be almost anywhere. I mean, if you think about it, I mean, the biggest hotel in the world doesn't own any property. It's Airbnb. The biggest taxi cab company doesn't have one car, right? It's Uber. So we're living in a world where companies can be extremely mobile. So more and more we're seeing small and startup companies wanting to push their income offshore and do the same sorts of planning that the big boys do. So we all have to be a little bit more aware of a lot of these issues. Subpart F. I've got an outline. In fact, I have an entire outline on controlled foreign corporations in your materials. So here's the concept at a high level. If a foreign corporation is more than 50% owned by U.S. persons, and that's a term of art, it means U.S. people who, or U.S. shareholders rather, which means U.S. persons who own more than 10% of the company. If they own more than 50% of the foreign corporation, then you have a controlled foreign corporation, which means that the U.S. shareholders, even if they have less than 10%, are going to be taxed on their share of this bad income, subpart F income of the controlled foreign corporation. It's complicated, it's involved, but it's the first question we need to ask. I mean, if you're going to go offshore, you're going to have a controlled foreign corporation. Because if you are, we have to be real careful about the kind of income that you put into that corporation. As an example, if you have purely passive income in that corporation, your share of it is going to be taxable back to you on an annual basis as though you got a dividend. That's subpart F. And these rules apply to all sorts of bad income. It's the kind of income that seems to be really easy to move around, that could just as easily be here in the United States. That's subpart F. That's number one. Number two, PFIC, passive foreign investment companies. Similar concept, except a PFIC, we don't have this 50% ownership requirement. It's just that we have a foreign corporation that a U.S. person owns shares in that has an excessive amount of passive income or passive assets. Okay, 75% passive income, 50% passive assets. And once a company is a PFIC, it's always a PFIC. So once a company has too much of this passive income, that means that every U.S. shareholder is going to have to pick up as if they're going to have, well, let me get to the tax treatment in a minute. Once we fail these rules, now we have a PFIC. That means that one of two things will happen. It means when the U.S. shareholder gets a distribution back from the PFIC, there's going to be an interest charge on it that's going to eliminate the benefit of tax deferral, and nobody wants that, and plus it's going to be taxable at ordinary rates. Or alternatively, the shareholder can make an election to treat the PFIC as what we call a qualified electing fund and just elect to be taxed on a current basis on their share of the passive income, which is what we always do, because nobody wants the interest charge. So those are the two rules we have to navigate when we're going offshore. Do I talk more about that? Let me talk more about that. So on subpart F, I told you about passive income. That's really not, nobody's really going offshore to create passive income, right? We're in active businesses. So we're really worried about one thing as a practical matter. We're worried about buying property in one jurisdiction and selling it in another. We're really worried about moving that sales gain into the Cayman Islands or some low tax jurisdiction. So here's the scenario. I wish I had a whiteboard. I could draw it out. But just picture, if you will, U.S. corporation has its foreign subsidiary, and we put it in a tax haven because we don't want to pay tax. It's in Cayman Islands, and we want to just trap some earnings there. Here's the evil. So what we do is we sell, our U.S. company will sell our widgets to Cayman company. Cayman company will turn around and resell it to somebody in China or wherever else their market is. Okay, that's bad subpart F income, right? That's just a paper company. The reason why, that's foreign-based company sales income. We purchased product in one jurisdiction, that's not our jurisdiction of formation. We sold it in another jurisdiction, that's still, again, not our jurisdiction of formation. That's the rule we try to get around. And one of the ways we get around it is through what we call the manufacturing exception. And the manufacturing exception says none of this applies if you're manufacturing, because people don't manufacture to avoid taxes usually, right? So if your Cayman corporation is engaged in manufacturing, that's okay, right? So if the Cayman company actually has a manufacturing facility, it can go ahead and manufacture and sell anywhere in the world. It won't have foreign-based company income. So just to give you a little history, the way this used to work is that some smart tax lawyers said, okay, well, we're going to contract manufacture. So Cayman company is going to hire this contract manufacturer in China, which will probably be a wholly owned subsidiary, by the way, to manufacture on its behalf, and then it's going to sell. So Cayman company owns a Chinese subsidiary. We enter into this magical contract, right? Contract manufacturing, creates the widget, then sells it in Europe. Now, if Cayman company just bought the product and sold it in Europe, that'd be that bad subpart F income, but because it's manufacturing, it's not. And the IRS came along, and we had lots of fights, you know, because there were cases that went in favor of the taxpayer, and said, yeah, you're right, you're manufacturing. You got a contract manufacturing arrangement. You're just using contractors. And the IRS said, oh, wait a minute, you know, you're not manufacturing. You're subject to the branch rule, which we could go into, but suffice it to say, what you've got is you've got a branch in a foreign country, and that's what you're not allowed to do. Well, the rules now are a little more clear. The rules now are that as long as the Cayman company actually has employees, it can engage in this sort of activity in a foreign country as long as it's got real employees providing significant services. then it is indeed a manufacturer. Now, let me tell you, I told you that to tell you this. So the typical scenario is that in my world, at least around here, our clients, they trade on technology. Remember I was talking about this mobile income? Well, that's technology, or intangibles at least. Not so much manufacturing. Not many of my clients are manufacturing things. They're mostly just doing something with their technology. So the technology, we want to put in an offshore jurisdiction, so the income from the technology in a tax haven jurisdiction can accumulate tax-free until we bring it back into the US. Remember what I said about passive income being bad income? Well, royalties are passive income. So if we set up our Cayman company and license to our French affiliate, we're going to have this bad royalty income come back to the Cayman company. That's going to pass through to us as Subpart F income, maybe it might even be a PFIC. So how do we get around that? And the way we get around that is through the check the box rules. But I'm getting way ahead of myself. Suffice it to say that the problem that we have through these anti-deferral regimes is that we can't typically move that intellectual property into an IP holding company and then passively license, because that's going to get taxed back to us. And that's what everybody wants to do. I'm going to show you how to do that in a minute. But first, I just want to say a couple things about foreign tax credits, because that's just to close the loop on all of this. And again, now we're going back to U.S. companies doing business offshore. And again, I have another outline where you can get the detail. But generally, under 901, U.S. corporations doing business in a foreign country and they're paying foreign taxes, they get a credit in the U.S. for those taxes. Okay, so let's talk about the 901 credit. That's a direct credit first. The payment has to be a tax, and the company has to actually elect to pay the tax. And there's a lot of definitions as to what is a tax, okay? And what's an income tax, for that matter. It has to be an income tax. And you'll see it in the outline, I mean, and who is actually the taxpayer. Because there are a lot of vehicles that play games with that technical taxpayer definition. The 902 indirect credit is probably a little more interesting. That's where you have a U.S. corporation that owns stock in a foreign corporation. The foreign corporation pays tax on its income and then sends the rest of the earnings back to the U.S. as a dividend. Well, those dividends carry tax credits. That's the 902 indirect credit. Okay, so those are the two kinds of credits: direct credit, indirect credit. The dividend, of course, has to be grossed up for the amount of the tax, and then you get the credit, right? So if you had $100 of earnings, you paid $20 of tax and sent $80 back, the U.S. company is going to pick up $100 of dividend, you know, because we gross it up, and a $20 credit if it claims it. Now, those are the two kinds of credits, and are all subject to one big limitation, so 904 limitation. And this is the complex part about this. And the basic idea is that we shouldn't be able to credit more foreign tax against our U.S. tax. We shouldn't be able to credit a higher rate of foreign tax against our U.S. tax rate. It seems kind of hard, given that we have the highest tax rate in the world, that could happen, but it could, right? So if we're paying if our effective rate in the U.S. is, I don't know, 30%, and we paid 35% on that income in the foreign country, we shouldn't get 35%. You know, we shouldn't get all of that tax as a credit. We should only get the 30%. So there's a formula that limits the amount of these credits. And the formula is in my materials. I'm going to read it because otherwise I'll say it wrong. Where's my formula? Oh, it's right, yeah, fraction, right there in 3A. It's the U.S. tax times a fraction, foreign source income over worldwide taxable income. All right, so we're just taking the foreign percentage. And that part doesn't seem so bad, but it gets worse. Now we got to split it into categories. There's passive income, financial services income, shipping income, and a high withholding tax interest income. So it's not as bad as it could be. We used to have 9 categories. Now we're down to 5. But basically, we're splitting passive income and active income up, in effect. So we do have to put it into categories, and each category gets tested. And to the extent that we have credits that are limited by this limitation, that's excess tax credit. That we can carry over, but we can't use it now. And most companies I know of are in an excess tax credit position. The other thing to think about here, it's a little bit of a sleeper, is the idea of overall foreign losses. So imagine a scenario where you've got a U.S. taxpayer that's doing business overseas and they have foreign losses. Well, they use those foreign losses against U.S. income. So it seems kind of unfair is that when that turns around overseas and they start generating income and pay foreign taxes, that they should be able to get the credit, you know, on the foreign taxes that they pay. So when we consider this calculation, this foreign source over worldwide income, we have to recapture these foreign losses first. And the way we do that is that our foreign source deductions are recharacterized. I'm sorry, our foreign income is recharacterized as U.S. source income for purposes of this calculation until we've recaptured all of those foreign losses. So that's it, kind of at a high level. That's the foreign tax credit. And then just a couple more rules. Cost sharing. So one thing you might have noticed about this whole regime that I've described is that, you know, gee, it's not very efficient for companies to be licensing property back and forth, right? There's withholding taxes. You know, we're creating passive income. We've got transfer pricing issues, right? Because we've got to price the royalties that we pay back and forth under this arm's length standard. So the rules have a construct known as cost sharing, where we can basically, if affiliates will share the costs of an intangible, then they don't have to license to each other. They can just use the intangible. It gets all around these transfer pricing rules altogether. And the way it works is that costs are shared based on expected benefit from the intangible. So if you have a U.S. company and its French affiliate, and they're both using the property, basically they just agree they're going to contribute to the cost of development of that intangible in accordance with their costs, with their expected benefit, and then they don't have to pay royalties to either party. And it works pretty slick, actually. We use cost sharing almost always now, whenever we can. And you might know there was recently a big case that invalidated some IRS regulations that would have required stock option expense to go into cost for purposes of calculating cost sharing. Because if you think about it, I mean, it's the U.S. company's options that are being used. That means the U.S. company would have more cost. The U.S. company would be allocated more of the income from the arrangement. So anyway, so there's a case that invalidated those regulations, but cost sharing is still a very, very common technique. Now, that's the environment. We talked about the international IP holding company, how we drop IP into, okay. Now, I want to go through a scenario. Now that I've given you all the rules, let's go through how this plays out in practice. Remember that company that I told you about that read in a paper about Apple and Google and eBay and everybody not paying tax? So they want to do business internationally, and they want to know what they can do. Well, rule number one is, here's what you can do. You can defer, until you bring it back to the U.S., you can defer U.S. tax on your foreign source income if you're careful, right? And remember the anti-deferral rules. You know, there's this CFC rule that's going to tax you on income of your controlled foreign corporations if it's that bad passive mobile type of income. And then there's a PFIC rule that's going to tax you if it's passive. So, but there's a way around this. And here's the structure. Step number one, we form our, we'll call it tax haven country, although I'd never would call it that, you know, in a document, but let's say it's tax haven country. And it's Luxembourg or Cayman or wherever we go these days. And the IP goes into that country. Now, this is way easier when you've got a company that's just starting out. So if we don't, this part here becomes a little complicated because the transfer by the U.S. company to the foreign tax haven company has implications. And the implication is it's what they call the super royalty provisions. If the U.S. company is going to transfer intangibles, not just intellectual property, but intangibles to a foreign corporation, it has to get back a royalty that's commensurate with the intangible, and it's going to be U.S. sourced. So that means there's no benefit to it, right? That basically prohibits U.S. companies from transferring intangibles. So what we do is we sell the intangible. So we have to value it and sell it to the foreign company. Remember that cost sharing rule I just told you about? Well, we're only going to sell the foreign rights to the foreign company, and we're going to cost share the rest of it. We're going to keep the U.S. rights in the U.S. because we can't avoid tax on the U.S. income anyway. Remember, whether you're foreign or U.S. So, but the foreign part, we can't avoid tax under these rules. So we're going to sell the foreign rights, and we're going to enter into a cost sharing agreement so the parties will contribute to future development based on expected benefits. All right, that's great. We got the IP offshore now. With that little step, it cost us a little bit of tax because we had to have a sale. Wish I had a pointer. It's right here under technology transfer. The next step is we want to do sales in, let's put the manufacturing aside for a minute. The next step is we want to do sales in our base countries. Let's say we want to do sales into Europe. So we form a European-based company. We got lots of good business reasons for doing that. But that European company has to access our intangibles. Now, how do we do that? Remember, if we have a license back to tax haven company, that's going to be passive income, or it's going to be subpart F income, right? Foreign personal holding company income, and it's going to get taxed back to the U.S. company. The way around that is by making a check the box election for the European company. So everybody familiar with check the box? So the code allows a taxpayer for certain types of entities to simply elect to treat them as disregarded entities if they're wholly owned corporations. Now, there's a list of corporations in the regulations they call per se corporations that you're just not allowed to be anything other than a corporation. But if you're not one of those per se corporations, you can check the box and be disregarded. So what happens if this entity is now disregarded? It means that tax haven company is deemed for U.S. purposes to be doing business in that country. So if it buys products and resells it in that country, we don't have that subpart F income anymore. And in fact, it doesn't even, we don't even have to go that far. This company doesn't have royalty income, right? Because it's getting a royalty from itself. So basically, tax haven company now has active trader business income from doing sales in the foreign country. So we don't have subpart F income. So that's the play. That's what we typically do. We can add one more piece to this, and that's the contract manufacturing piece. This is a very old slide, by the way. This is back under the old rules. We don't have to do this anymore. Now we just have to have employees here, and we can qualify as a manufacturer. So we get around the branch rule that I mentioned earlier. So that's basically how it all comes together in a typical technology company that wants to move offshore. Well, we got a few minutes for questions. Anybody wants to drill down a little deeper on any of these? I think your hand was up first in the back there.
Sure. This goes back to kind of the U.S. branch, U.S. corporation. We have a foreign subsidiary, which are a U.S. subsidiary of a foreign parent and a foreign parent. What I've seen done is I've had attorneys suggest no filing with 1120F from the parent, from the perspective that if there's any activity that could possibly be looked at as being done in the U.S. by the parent, you will not be able to get expenses allocated to get rid of the gross income piece that would be allocated to the parent. I've always thought it as a little overly precautionary to file 1120F.
Oh, yeah.
And I just kind of want to know, when in those situations, would you want to do that? Why would you want to do that? That type of stuff.
Yeah, so the rule that he's talking about is that, so if a foreign corporation is doing business in the U.S., they're taxable on their net income, provided they file a tax return. So the problem is foreign corporations can be doing business here and not think they're doing business, so they don't file a tax return. Then the IRS comes along and they discover that they are, and they say, okay, we'll file our tax return. And it's like, well, that's great, but you don't get any deductions, because you only get deductions if you file a tax return, and you didn't file a tax return. That's the problem. That's the issue, and I've heard that a lot. And I've seen companies where there's enough of a question where I've advised them to file the return as well, just to protect themselves. But it kind of depends. I mean, if it's a treaty country, I'd be a lot less concerned about it, first of all, because there's a lot less risk. And then we just have to look at the nature of the business and the facts. But I haven't seen foreign corporations do that for a long time because the whole point of our inbound structures is so they don't have to file returns. So I think they're better off just being sure that they don't have dependent agents here or employees or a permanent establishment. But yeah, that's a very good point because I've actually seen companies get nailed on that. You had a question?
So I have a little silly question. So, you know, the word effectively connected,
Yeah.
it was not there in the code in 60s. It was brought inside the code, that little term of art. What was the real purpose or what is the significance? I understand effectively connected, like, you know, it differentiates between 30% or the flat rate versus the regular tax that you calculate. But what was the real significance? They could have just said, if you do business in US, you earn money in US, you pay tax in US. You don't do, there's nothing. But instead, they use this word effectively connected.
Yeah, no, there's a reason for that. It's very much a term of art. It means something different than attributable to, you know, and if you go through the regulations, for example, there's this thing called the limited force of attraction rule, which, remember what I said, it's hardly ever you get foreign income that gets taxable in the US, foreign business income. Well, there is a way that could happen. There's this limit, it's called force of attraction. And you could theoretically have a US office that's materially involved in producing foreign income and not have a foreign office. Okay, if you have that scenario under the regs, you have US income. So I think effectively connected, we needed something a little broader, you know, to cover the fact that we have this limited force of attraction rule. That's why I think we got this new terminology, but you're right, that came in
66, 67.
Yes,
somewhere,
I thought it was
somewhere in
under
60s.
Kennedy, but yeah, something like that. Yeah. Okay, why don't we take 10 minutes and we'll be back with state and local. Okay, thanks very much.